Welcome to this Killick Explains video, and welcome to a tour of a piece of jargon which is used in quite a number of places in financial markets, and that piece of jargon is arbitrage. Now, before you turn off thinking what on earth are you talking about this time, actually it's quite an important concept to understand. It's used widely in the hedge fund world and it can be used elsewhere. So a jargon busting tour, what is it? What are some of the downsides? So first of all, what is arbitrage? Well, it's the idea that pricing anomalies can arise in financial markets. And a pricing anomaly is simply something isn't priced correctly when it's available in more than one place, if you like. And as soon as that happens, you get people who jump in and think, well, there's an opportunity here to take advantage of that price difference. And I'll explain exactly what I mean in just a moment by that. The aim is to make money. And usually there are two stages to an arbitrage trade. There's buying something and there's shorting or selling something. And I'll come back to that in just a moment. So some examples, if you're thinking, what on earth are you talking about? Famous examples. There was a chap who for a while imported VW Golfs from the continent and resold them in the UK. He bought them cheap on the continent, resold them in the UK because the price differential allowed him to do that, taking account of purchasing, transportation and sale costs. Now, after a while, VW worked out what he was up to and closed the pricing gap, if you like, and it disappeared. But that's an example of arbitrage, spotting a mispricing between two different markets. I'll give you another example, a famous case where a chap was watching or listening to Spanish football matches live on a radio signal and worked out that spread betting companies that allow you to basically bet in the middle of a match were relying on a Sky signal bounced from Spain via satellite into London, which took 7 seconds. So he realised he had 7 seconds to place a non-losable bet, essentially. So with the right kit connecting him into a bookies, he could get a bet down ahead of, for example, a penalty kick being taken, knowing the outcome. It's almost like knowing the future. That's arbitrage. It's not illegal. That opportunity evaporated when the spread betting companies worked out what was happening and started to delay placing bets by the time it took to bounce the signal from Spain through the satellite back to London and so on. You get the idea. But that is arbitrage. Nothing illegal about it. Now, if you look in financial markets, where do you see arbitrage opportunities? Are there opportunities potentially for retail investors to benefit? Well, there are. I'll give you some technical examples in a moment, but what about some non-technical ones? Sometimes you might look at a fund manager's strategy wrapped into a unit trust and the same strategy wrapped into an investment trust. Now, I cover what these are in other videos, but essentially some people will say, hang on a minute, the investment trust is pricing the same strategy as is available through an authorized unit trust at a discount, because investment trusts are traded on public markets, they issue shares, and you can get a discount or premium to the underlying net asset value. And there are some people out there who will try and take advantage. So if they see an investment trust trading a particular strategy cheaper than unit trust, they'll try and buy it to take advantage, if that makes sense. Then you get people who do a very simple form of arbitrage, you could argue. They look at shares and they say, well, the intrinsic worth is not reflected in the current share price, so I'll try and take advantage of that. And then you get the technical versions of arbitrage. Now, I mentioned there are opportunities sometimes when you get the same asset priced differently in different markets. So Nick Leeson, if you remember him, who ended up serving time, recognised that at a certain time in the day, where one market in the Far East was doing what I'd call open outcry trading, which is something of a thing of the past these days, and another one on the same asset was doing electronic trading, there was a moment in the day where a price differential arose. Perfectly legal to try and take advantage by buying the cheap asset and shorting or selling the expensive one. Then there's M&A. There are professionals out there who recognise that when a company looks to buy another company, you sometimes get a bit of a pricing differential. What pricing differential? Well, it arises because the target usually starts rising in price as people anticipate the bid coming in, and the predator starts to fall as people question whether it will be able to actually make sense of this new combined entity. So you get M&A arbitrage. And then there's To give you a technical one, convertible arbitrage. Now, if you're wondering what that is, I do convertible bonds in another video, but essentially that's people saying, wait a minute, here's a bond that potentially converts into shares at a point in the future. I think it's mispriced relative to the value of those conversion rights. So again, it's a two-pronged trade where you buy one side and sell the other. Now, who does arbitrage in practice? It tends to be professionals. It tends to be people who know their way around the markets. I mean, that investment trust, unit trust discrepancy I mentioned is all about knowing your stuff when it comes to funds, for example. But in theory, anyone can do it. Dangers with arbitrage. Number one, you can be doubly wrong. Imagine you buy something and sell something. So you're expecting the trade to go a certain way and it doesn't. It goes against you. You could lose on two separate legs of the same trade. You can be too slow. So it's all very well knowing that somebody's making money out of football matches or importing VW Golfs, for example, but by the time you get around to it, maybe the opportunity's been lost and or it may simply disappear because the people who've allowed the arbitrage opportunity to arise in the first place may close it down. The other thing I'll mention, and then we'll wrap up, is that not everybody can take advantage of falling prices or anticipate falling prices, anticipate something dropping because it's too expensive. It requires you to be able to do something called shorting the market. Now, actual shorting is something that only professionals can do. There are some other ways to achieve it through derivatives, but frankly, it's quite risky. So there you have it. Arbitrage used quite heavily amongst market professionals, not used terribly heavily outside of that arena, but a piece of jargon you will come across and one that's well worth knowing about. Now, if you'd like to know more about any of the topics I've just gone through, I mentioned funds, I mentioned convertibles, for example, do feel free to access our comprehensive library, killick.com/learn. And if you'd like a copy of any of my guides, a couple of examples sitting next to me here, one of them is all about equity markets, then do please ping me an email, editor@killick.com.